$938 billion. That is not a statistic. It is not a line item in a quarterly report. It is a loaded weapon that the People's Republic of China has just cocked and aimed directly at the heart of the American financial system. And on February 9th, 2026, the order was given. Beijing directed its major banks, its state-owned financial institutions, its regulated investment firms to begin reducing their holdings of United States Treasury bonds. Not because a fund manager decided to rebalance a portfolio. Not because a risk model flashed a warning. Because a government regulator in Beijing issued a formal directive citing volatility and safety. A directive backed by the full authority of the Chinese state. $938 billion. That is the combined US Treasury exposure of China and Hong Kong. And that is the arsenal that has just been officially authorized for deployment against the bond market, that your mortgage rate, your retirement account, your savings, and your entire financial future depend upon. This is the most dangerous financial event of 2026, and almost no one in the mainstream media is telling you what it actually means for you. Before we break down exactly how this directive detonates inside the American economy and what you can do right now to protect yourself, please make sure you are subscribed to the channel and turn on the notification bell. This situation is moving fast, and we are tracking it daily as new data comes in. And drop a comment right now with one word: bonds or gold. Tell us where you are placing your trust in this environment. We read every single response, and it tells us how this community is preparing for what is coming. To understand why this directive from Beijing is the financial equivalent of a nuclear option, you have to understand the machine it is dismantling. For over 40 years, the United States has been running the most elegant financial arrangement in the history of sovereign debt. The mechanism is simple, and its simplicity is what made it so powerful. America spends more than it earns, routinely, structurally, year after year. It covers the difference by issuing Treasury bonds, IOUs stamped with a full faith and credit of the United States government. Foreign governments and central banks, led by China and Japan, would buy those bonds, taking the dollars they earned from selling goods to American consumers and recycling them directly back into American debt. This cycle kept U.S. interest rates artificially low for 4 decades. It subsidized the 30-year fixed mortgage. It allowed the federal government to run trillion-dollar deficits without immediately paying the consequence in the form of rising interest rates. It was, for the American consumer, an extraordinary subsidy on your standard of living, financed by a foreign nation that found the arrangement equally beneficial. China sold us cheap goods. We paid in dollars. They reinvested those dollars into our treasury market. Both sides benefited. But the trade war of 2026 has officially ended that cycle. The semiconductor sanctions, the tariff escalations, the Taiwan tensions, the technology decoupling, these have transformed a financial partnership of 4 decades into an adversarial standoff. And now Beijing has made its most consequential move. It has not imposed new tariffs. It has not restricted rare earth exports. It has done something far more surgical and far more damaging. It has canceled the credit line. It has issued a formal government directive ordering Chinese financial institutions to reduce their single largest foreign asset holding, $938 billion in United States Treasury bonds. The TIC data, the Treasury International Capital Report that the US Treasury publishes monthly to track foreign holdings of American securities, has been warning about this trajectory for months. China's official holdings of US Treasuries have been declining steadily. But here is the critical information that the mainstream headlines routinely omit. China uses custodians in Belgium, in Luxembourg, in the Cayman Islands, and in other third-party financial centers to mask the true scale of its selling. The official headline number understates the actual selling pressure by design. This practice is well documented by researchers at the Federal Reserve Bank of New York, and it means the real exposure being sold is almost certainly larger than the $938 billion the data shows. And China is not alone. This is the detail that makes this situation qualitatively different from anything we have seen before. Brazil has already dumped $61 billion in US Treasuries over the past year. India has shed $47.5 billion. Saudi Arabia has been diversifying away from dollar-denominated reserves since the signing of its agreement with China for oil trade settled in yuan. These are not isolated portfolio decisions. These are countries watching China's playbook and beginning to execute the same strategy. When the world's second-largest economy issues a formal government directive to reduce exposure to US debt, every other central bank on the planet receives the signal. Every finance ministry runs the same calculation. If Beijing is ordering its banks out, what do they see that we need to prepare for? The answer is mathematical, and it is devastating. Here is the mechanism and why it touches every American who has a mortgage, a retirement account, a savings deposit, or a credit card balance. The United States government is currently running a deficit of approximately $2 trillion per year. That means for every dollar the federal government spends, it collects only about 65 cents in taxes, and it borrows the remaining 35 cents by issuing Treasury bonds. Every single week, the Treasury Department holds auctions to sell billions in new bonds. At those auctions, the competitive bidding among buyers determines the yield, the interest rate the government must promise to attract capital. In the decades of the old arrangement, China showed up reliably at those auctions, absorbing a massive slice of each new offering. Japan did the same. Other foreign central banks added their bids. The competition among buyers was robust, which kept the yields low, which kept the interest rate the government paid on its debt low, which kept the rates on your mortgage and your car loan low. Now remove China. Not only is China absent as a new buyer, it is simultaneously liquidating its existing $938 billion position into the secondary market. This creates what bond traders call a supply shock. More bonds hitting the market from sellers, fewer buyers arriving at the auction to absorb them. In any functioning market, when supply overwhelms demand, price falls. In the bond market, the relationship between price and yield is fixed and inverse. When bond prices fall, yields rise. They cannot do otherwise. It is the arithmetic of fixed income. The coupon payment on the bond is fixed. If the bond price falls, the yield calculation rises proportionally. There is no ambiguity. There is no way to avoid the math. When the 10-year Treasury yield rises, the 30-year fixed mortgage rate follows it, because banks set mortgage rates as a spread above the 10-year Treasury. If China's sustained selling pushes the 10-year yield from its current level to 6%, 30-year mortgage rates will mathematically reach 9%. Not because of Federal Reserve policy, not because of inflation surprises, because $938 billion of supply is hitting a market with a shrinking buyer base. The Federal Reserve is explicitly powerless in this scenario. The Fed sets the overnight federal funds rate, the rate at which banks lend to each other for 24 hours. It does not set the yield on the 10-year or 30-year Treasury. Those yields are determined by the market, and if the market is being flooded with Chinese selling while domestic buyers are already stretched, the Fed can cut rates to zero tomorrow, and mortgage rates will still rise. This is a concept called fiscal dominance, a regime where the supply of government debt overwhelms the capacity of monetary policy to control long-term interest rates. We are entering that regime now, and the Chinese directive of February 9th has accelerated the timeline by an order of magnitude. 9% mortgage rates are not a forecast. They are the mechanical output of the supply-demand equation in the Treasury market when $938 billion is added to the sell side. 9% mortgage rates mean that a family earning $100,000 per year can afford to borrow approximately $250,000 to buy a home, versus the $500,000 they could afford at 3% rates 2 years ago. The effective purchase price of the American dream has been cut in half by the math of debt repricing. And it is only beginning. But the story does not stop at the housing market. There is a second front already opening, and it is inside the American banking system, where the damage is already accumulating in real time. According to data published by the FDIC, the Federal Deposit Insurance Corporation, United States banks are currently carrying over $600 billion in unrealized losses on their securities portfolios. These are Treasury bonds and mortgage-backed securities that banks purchased when interest rates were near zero in 2020 and 2021. At that time, those bonds paid 2 or 3% annually. Today, with yields at 5 or 6%, those same bonds are worth dramatically less. A bond paying 2% is worth substantially less in a world where equivalent bonds pay 6%. The mathematical difference between the purchase price and the current market value is the unrealized loss, $600 billion of it, sitting on the balance sheets of banks across the United States. The reason these losses have not yet caused a crisis is an accounting rule called hold to maturity classification. If a bank declares that it intends to hold a bond until it matures, it does not have to mark the bond to its current market price. The loss is invisible to the income statement as long as the bank never sells the bond. But there is a condition. The accounting fiction only holds as long as depositors are not withdrawing money. If customers pull their deposits, the bank must sell bonds to meet the withdrawals. When it sells at a loss, the unrealized loss crystallizes into a permanent, reportable capital destruction. This is precisely what destroyed Silicon Valley Bank in March of 2023. A bank run of $16 billion in a single day forced the sale of underwater bonds, crystallized the losses, and collapsed the institution in a weekend. What is happening now is the same mechanism operating at a scale that is orders of magnitude larger. China's sustained selling is not a sudden shock. It is slow and deliberate pressure, designed to grind yields higher week after week, making those unrealized bank losses slightly larger every day. It is a siege strategy laid with precision by a government that understands the structural vulnerabilities of the American banking system better than most Americans do. Beijing knows that $600 billion in unrealized losses is a pressure point. Sustained yield pressure will eventually force a choice. Either banks restrict lending to avoid adding new duration risk, or they continue to hold and watch losses grow until a depositor panic triggers the forced sale. Either path damages the American economy. The Bank Term Funding Program that saved the banks in 2023 has expired. This leaves the Fed with a binary choice. Let the banks fail or print trillions to monetize the losses. Both options destroy the dollar's purchasing power. They are playing a game of extend and pretend, a dangerous strategy of delay, hoping the situation resolves itself. It will not resolve itself when the selling is coming from a government directive, but here is where it gets worse. The banking sector is only the second domino. The third domino is the American housing market. Office vacancy rates in the major American urban centers are hovering between 25 and 35%. The pandemic permanently restructured how corporations use office space. Buildings that generated $1 million per year in rental income 3 years ago are generating $200,000. The owners of these buildings, which include regional banks, pension funds, and private equity firms, borrowed heavily against projected cash flows that no longer exist. Over $1 trillion in commercial real estate loans are maturing between 2024 and 2026. They must now be refinanced at rates 3 to 4 times higher against property values that have fallen 20 to 40%. The math does not work. What it produces instead is mass default, and every commercial real estate default is a loss absorbed by the lender, which is frequently a regional bank already carrying unrealized losses on its treasury portfolio. But here is where the story shifts from a real estate problem to something that reaches directly into your retirement account. The American pension system. Public and private pension funds in the United States are currently allocated according to the 60-40 model. 60% in equities, 40% in bonds. For 40 years, this worked perfectly because stocks and bonds moved in opposite directions. When the stock market fell, bond prices rose, providing a cushion. The bond allocation protected the portfolio when stocks crashed. But that inverse correlation has broken down. In a world where bond prices are falling because of foreign selling and rising supply, stocks and bonds fall together. The 40% of your pension fund that was supposed to protect it is now the source of additional losses. Pension funds across the United States are seeing their bond portfolios hemorrhage value simultaneously with any equity market weakness. We saw a preview of this in 2022, when both stocks and bonds lost double digits in the same year for the first time in 40 years. What is coming now will make 2022 look like a warm-up exercise. And beneath the pension system, there is a fifth domino that almost no mainstream analyst is discussing. The shadow banking system that connects your money market fund and your brokerage account to the same treasury market that Beijing is now liquidating. Hedge funds and insurance companies borrow against treasury collateral using short-term repo markets. When treasury prices fall, the collateral loses value. Margin calls fire, and forced selling drives prices down further, triggering more margin calls. The last time this spiral began in the treasury market was March of 2020. The Federal Reserve had to intervene with unlimited bond buying within days. This time, the trigger is a government directive from Beijing that is not going away and that the Fed cannot negotiate with. Wealth is never destroyed. It is merely transferred. And right now, it is transferring away from anyone who does not understand what is happening. And this brings us to what this means for you, specifically, personally, today. Your deposits. The money in your checking account, your savings account, your money market fund, sits inside institutions carrying unrealized losses. You deposited that money believing it was in a vault. What they did not tell you is that it was invested in treasury bonds and mortgage-backed securities that are now worth less than what the bank paid for them. Your deposit is not a safe asset. It is a leveraged bet on the US bond market that you never agreed to make, your mortgage. If you have an adjustable rate mortgage or any variable rate debt, your monthly payment resets against treasury yields. Every time China sells a bond and pushes that yield higher, your payment rises at the next reset date. For millions of Americans, the $938 billion sell order is a personal bill arriving at their specific address on a specific date this year. Your retirement account. The 40% of your 401k allocated to bonds according to the 60-40 model is in the same instruments that China is dumping. And unlike in previous downturns, your stock allocation may be falling simultaneously because rising yields compress growth stock valuations by increasing the discount rate on future earnings. The diversification you were sold no longer provides the protection it once did. Your credit card balance. Every major American credit card is tied to a variable benchmark rate. As Treasury yields rise, your interest charges rise. You are paying for China's bond selling every single month in the form of a higher minimum payment. You are paying the geopolitical risk premium every single month, whether you realize it or not. Your bank account is not a vault. It is a highly leveraged institution betting your deposits on a bond market that is now under state-sponsored attack. They are not using missiles and tanks. They are using Treasury sell orders and yield pressure. The result for your household budget is the same. The window is narrowing. The opportunity to protect your financial future still exists, but it is closing, and the speed of its closure accelerates with every bond that China sells. Here is what closing the window looks like. Capital controls. Restrictions on how much of your own money you can withdraw from your bank account in a given week. Bank holidays. Government-declared closures of the banking system while losses are assessed and recapitalized. And the mechanism that most Americans have never heard of. The bail-in provisions of the Dodd-Frank Act, passed in 2010. Not a bailout, where taxpayers fund the rescue of banks. A bail-in, where depositors fund it. Under Dodd-Frank's Title II provisions, your deposits can be legally converted into equity in a failing institution to recapitalize that institution. Your bank account, your savings, converted into shares of a failing bank. Shares that may be worth pennies. This is not theoretical. In 2013, Cyprus implemented a bail-in over a single weekend. Accounts above 100,000 euros were frozen without warning. A portion of those deposits was converted into equity in failing banks that subsequently became nearly worthless. This happened in a developed European nation with functioning democratic institutions. It happened in 72 hours. The regulators did not announce it in advance. They announced it after the decision was made, after the markets were closed, after there was nothing depositors could do. The FDIC insures deposits up to $250,000 per account per institution. What they are not telling you is that the Deposit Insurance Fund holds approximately $125 billion. Total insured deposits in the United States banking system exceed $10 trillion. That is a coverage ratio of approximately 1%. 1%. If 5% of insured deposits needed to be paid out simultaneously, the FDIC would be insolvent within hours. The full backstop is the US government's ability to issue more debt or print more currency. In an environment where the bond market is already under supply pressure from China's $938 billion sell order, issuing more Treasury bonds to fund FDIC bailouts means adding more supply to an already overwhelmed market. That additional supply drives yields higher. Higher yields make bank losses worse. The feedback loop has only one mathematical output. By the time they admit there is a crisis, the capital controls will already be in place. By the time the bank holiday appears on a government website, the window will have closed. The signal will not come from a press conference. It will come from a Sunday evening announcement when the markets are closed. And there is nothing you can do until Monday, when the rules have already changed. Do not be the last person standing outside the bank on Monday morning. The time to act is before the announcement, not after. Here is the practical, actionable plan. 5 specific steps you can execute this week to reduce your exposure and position yourself ahead of what the bond market is now mathematically telling us is inevitable. Step 1. Keep your deposits within the FDIC insurance limit of $250,000 per account per institution. If you have more than that at a single bank, divide it across multiple institutions. Joint accounts, individual accounts, and retirement accounts at the same bank are each insured separately. Understand the structure before you need it. Stay within the insured threshold, and stay in the priority queue. Step 2. Audit your specific bank's exposure to unrealized losses and commercial real estate. This data is publicly available through the FDIC's website and the bank's quarterly regulatory filings. Look at the ratio of unrealized losses on securities to total Tier 1 capital. If that ratio exceeds 15%, the institution is materially stressed. Regional banks with heavy commercial real estate loan portfolios carry the highest risk of a forced selling event if deposits begin to move. Step 3. Allocate a meaningful and growing percentage of your net worth into physical precious metals. Not a gold ETF. Not a digital gold account, not a futures contract. Physical metal in your direct possession, stored outside the banking system, where no bail-in provision, no bank holiday, and no custodian bankruptcy can reach it. Central banks around the world purchased over 1,000 metric tons of gold in 2024, the highest level in over 50 years. They are not buying it because they like shiny rocks. They are buying it because gold is the only reserve asset that cannot be frozen, cannot be devalued by a printing press, and cannot be subject to a bail-in. The distinction between owning a paper claim on gold and owning physical gold will be the most important financial distinction of this decade. Step 4. Eliminate every variable rate debt obligation you carry. Credit cards, home equity lines of credit, adjustable rate mortgages, variable rate business lines of credit. These instruments all automatically increase their cost to you as Treasury yields rise from China's selling. Every basis point of yield increase is a direct cost transferred to every variable rate borrower in America. Pay down credit card balances aggressively. Convert adjustable rate mortgages to fixed rate where the numbers support it. Remove the automatic linkage between your household budget and Beijing's government directive. Step 5. Open a Treasury Direct account directly with the United States Department of the Treasury and buy short-duration T-bills directly from the government, without a broker, without a bank custodian. Treasury bills with maturities of 4 weeks, 13 weeks, or 26 weeks reprice frequently, meaning you capture the benefit of rising yields without locking into a 30-year instrument that continues to fall in price. And your Treasury Direct account exists outside the banking system's custody structure. If your bank fails, your Treasury direct account is unaffected. The government owes you the money directly, not through an intermediary that may become insolvent. These are not the steps of someone who believes the system will collapse tomorrow. They are the rational steps of someone who reads the TIC data, who understands the mechanics of bond supply and demand, and who recognizes that a government-issued directive covering $938 billion in a single asset class is not a normal market event. You have the information now. You have the data. You understand the mechanism. Most people will watch this crisis develop from the outside, confused by the headlines, angry at the outcome, wondering why no one warned them. You are not that person. You are watching this because you sense that the financial narrative being sold to the public does not match the mathematical reality underneath it. Your instincts are correct. The smart money already knows. The institutional investors who manage sovereign wealth funds, the family offices of the genuinely wealthy, the central banks of nations that study these capital flows for a living, they are not staying in long-duration US bonds. They are not keeping deposits in institutions with balance sheets full of unrealized losses. They are building their lifeboats while telling you to enjoy the cruise. Most people will be blindsided. You will know exactly why it is happening. China's directive is not a beginning. It is the official announcement that the 40-year arrangement has already ended. The recycling of trade surpluses into American debt is finished. The interest rate subsidy that made American mortgages and American deficits affordable is being withdrawn by government order, with Brazil watching, with India watching, with Saudi Arabia watching. If the chain reaction spreads, there will not be enough buyers left for American debt. Bond yields will rise to wherever they need to rise to clear the market, higher than any projection in your mortgage, your retirement plan, or your business model. Return of capital is now more important than return on capital. The cheap foreign money is gone. The buyers who made it cheap are gone, and the bill is finally coming due. Knowledge is your armor in this fight. Preparation is your shield. You have the information, you have the data, you have the choice to act. Use it now, while the window is still open, while capital controls have not yet been implemented, while you can still move freely and reposition without restriction. Stay liquid, stay skeptical, stay ahead of the collapse. Subscribe to the channel and turn on the notification bell so you are alerted the moment the next data point moves. We are tracking TIC data, FDIC filings, Treasury auction results, and central bank gold flows daily, and we will bring you the updates as they happen. Share this video with anyone you know who has savings in a regional bank, a retirement account allocated to bonds, or a mortgage with a variable rate. You might just save their financial future. The algorithm does not promote this kind of hard economic truth, so we need your help to spread it. Together, we can navigate this collapse and emerge with our wealth and our freedom intact. I will see you in the next video with more data, more analysis, and more truth.